The government says it's borrowing money. That sounds harmless, temporary, almost responsible. But here's the uncomfortable truth. Once a government is deeply in debt, it no longer fully controls its own money, not the way you think it does. Right now, nearly every major government on earth is running deficits. Trillions borrowed, rolled over, borrowed again. And most people assume the story is simple. The state spends, the central bank manages things, and eventually growth fixes the bill. That assumption is wrong. And understanding why matters more now than it has in decades. Because when debt gets large enough, power quietly shifts. Not with a vote, not with a coup, but with math. Let's start with the basic premise. When a government needs money, it issues bonds. IOUs, you lend us cash today, we'll pay you back later with interest. At first, that sounds like control. The government sets the terms. The currency is its own. The debt is sovereign. But here's the catch. No one says out loud, the government does not buy its own bonds. Someone else does. Banks, pension funds, insurance companies, foreign governments, and increasingly massive asset managers with more money than most countries' GDP. The moment those bonds are sold, control starts leaking outward. Because debt is not just money owed. It's a relationship. And in that relationship, the lender always has leverage. Early on, it's subtle. Interest rates are low. Demand is strong. Politicians celebrate market confidence. But confidence is not loyalty. It's conditional. As debt grows, the government must refinance old loans with new ones. Again and again and again. Eventually, a strange thing happens. The state stops choosing times, whether times to borrow, it must borrow, just to keep standing still. This is where control begins to flip, because now the market isn't asking, should we lend? It's asking, at what price? Interest rates become the real vote. A silent referendum is held every day. If investors get nervous, rates rise. If rates rise, debt servicing explodes. If debt servicing explodes, budgets break. Hospitals, infrastructure, defense, and welfare all compete with interest payments. And interest doesn't negotiate. Governments learn this lesson the hard way. Greece learned it in 2010. The headline said bailout. What actually happened was surrender. Bond markets froze. Borrowing costs spike. And suddenly, unelected institutions were dictating pension cuts, tax hikes, and public spending. Not because they hated Greece, because the math demanded it. This is the first uncomfortable reveal. Once debt is large enough, markets don't just price risk, they shape policy. Now let's talk about central bank, because this is where the public story gets comforting. People say, don't worry, the central bank controls money, they can print. And technically, that's true, but power is not the same as freedom. When central banks print to buy government debt, they are choosing the least bad option. Stabilize markets now. Deal with inflation later. This works until it doesn't, because once markets times expect times intervention, the central bank becomes trapped. If it stops buying bonds, yields spike. If yields spike, the government panics. If the government panics, the economy follows. So the printer stays on, quietly, reluctantly. At that point, who's really in charge? The government can't stop borrowing. The market can't stop demanding protection. And the central bank can't stop intervening without causing damage. That's not control. That's mutual dependency with a gun made of interest rates. Here's the second uncomfortable piece. Debt changes incentives. Politicians start thinking in bond cycles, not election cycles. Central banks start prioritizing market stability over price stability. And financial institutions learn that risk is socialized while profits stay private. This isn't corruption in the movie villain sense. It's structure. When debt is massive, stability becomes sacred. And stability always favors the largest players. Small businesses fail. Households absorb inflation. Asset prices get protected. This is why financial crises often feel unfair, even when they're managed well. Now compare this with the public narrative. We're told debt is normal. Deficits don't matter. Growth will handle it. Money is just numbers. But the reality is colder. Debt creates invisible hierarchies. Creditworthiness becomes power. And confidence becomes governance. Countries with reserve currencies get more room to maneuver. Countries without them face discipline fast and hard. That's why some nations inflate quietly. Others collapse loudly. And here's the irony. The more safe a government appears, the more debt it can accumulate. The more debt it accumulates, the less flexible it becomes. Strength turns into fragility, just slowly enough that no one notices, zoom out far enough, and you see the long-term risk. Not default, not collapse tomorrow, but stagnation, policy paralysis. A system where every decision is filtered through markets that demand reassurance, where innovation takes a backseat to debt management, where future growth is borrowed from before it exists. So who actually controls money when governments are in debt? Not one villain, not one institution. It's a triangle. Governments that must borrow, markets that must believe, central banks that must intervene. Each sits unstrained by the others. None is fully sovereign. And the real power, it belongs to the rules of the system itself. Interest, expectations, and the quiet tyranny of arithmetic. Which leaves us with an uncomfortable final question. If no one is fully in control and the debt keeps growing, what happens the day the math stops cooperating?